Investors of the internet, investors of YouTube, welcome to an extremely volatile week. Not only do we just have economic data coming out this week that's going to really rally the market, we have something called triple or quadruple witching. This actually happens every quarter in the stock market. On the last month of the third Friday of that month, we have volume increase as much as 50% above normal, and so it gets extremely volatile. So triple witching is the expiration of stock options, stock index futures, and stock index options on the same day, that third Friday of the last month of the quarter, which is this Friday. Now, quadruple witching is a simultaneous expiration of stock options, stock index futures, stock index options, and one to throw in here, single stock futures derivatives contracts. Now we can see just how important this is by looking at this chart from Tier 1 Alpha. Basically what this person is saying is it's the largest notional expiration in the past decade. 2.43 trillion is sent to roll over and expire, and this giant red line, this bar, is essentially what is going to be expiring in terms of options and futures contracts and things like that in this Friday, right? And look how much higher it is going back, let's say, all the way to 2021, 2020, 2019, 2018, right? It's much higher. So very, very potential volatile time period. Could be good, could be bad for stocks, but volatility nonetheless. Now, on top of the quadruple witching event, which already is going to insert a bunch of volume and volatility inside the stock market, we have two other very important things that are happening this week. One just happened and one is happening very soon. So tomorrow, what's going to happen is the Fed's going to come out and they're going to tell us whether or not they're hiking rates. They're expected to hike from 4.25% to 4.5%. So what's going to happen? Well, if they end up hiking it higher than that, the market's probably going to reverse and it's going to be very bearish for the market. If they don't hike any more than 4.25 to 4.5, honestly, my opinion is it's probably not going to be a huge effect on the market because it's pretty much pricing in. We're going to talk about it in a second. Next up, we have what just came out yesterday, the CPI number. We actually got some good news. Maybe this can help us get to potential Santa Claus rally where we can get some decent stock prices by the end of the year. So CPI or inflation came out at 7.1% year over year. So from November of 2021 till November of 2022, we had 7.1% increase in the headline inflation number. Now compare this to the estimates of what analysts, economists thought was going to happen. They thought it was going to be a 0.3% month over month increase or a 7.3% year over year increase, and we got 7.1. So we had a surprise to the downside. That's a good thing if you are long the stock market, if you're bullish on the stock market. Or you can look at core CPI here, which came out at 6%, and it had estimates of 0.3% month over month and 6.1% year over year. So actually core also surprised to the downside, also a good sign. Now this is what JP Morgan released from JP Morgan's trade desk, and this is their game plan for investors to play on CPI. And I just wanted to show, it's kind of funny like how kind of off this was. So 7 to 7.2%, the probability that JP Morgan was giving was a 15% probability that this could happen. Now we know it happened, so okay, it was within that 15% probability, so it was a much less likely scenario to happen, but what they thought was the market was going to be up 4 to 5% when that does happen. Now compare this to the probability they had of it being 7.2 to 7.4, a 50% probability. They thought the market would be up 2 to 3% without that kind of surprise to the downside. So they were expecting the market, the S&P 500, we'll use that as the market benchmark. They thought that that was going to rally between 4 and 5%. Right now we're looking at a 1 hour chart, and you can see here, this is the gap up. So CPI came out, we could see here, Monday, December 22nd. So that was market close. And between market close and market open, we're talking about 2.56% open for the market, right? So the market gaps up, it opens up at 2.56% up for the day, not close to that 4 to 5% that JP Morgan was projecting. And then guess what? Something spooked the market. I don't know what it was. I haven't figured it out yet, but basically we're looking at from that peak in the market when it got up to about 4,100 on the S&P, it retraced back to 4,019, about almost 2% down from that peak. So there was a big move reversal basically for the market during that day. Now in a few minutes, I'm going to show you the triple witching dates going back this year and what happened on those dates and just how big volume was and the moves in the market. But also we're going to show you what's going on kind of in a downtrend channel of the S&P 500 and how we're actually really close to the downtrend line, and that may be a signal. If it does break through that line, we could see things go up higher. I'm going to show you that in a second, the chart, but we do want to go through really quick inflation and what's happening right now. Now here's the thing with analysts, and when it comes to inflation and interest rates, they apparently, according to Jim Bianco here, they always revert back to 2%. This black line we're looking at here, this is what actual inflation has been, and you can see every time going back, let's say into September of 2018, it was reverting to 2%. So analysts, economists, they're saying, okay, well, inflation is just under 3%. Well, we think it's going to come down to 2%. Once it actually does go down and it's under 1% back in the 2020 time period, well, now they think, oh, it's going to go up back to 2%. They're always saying that it's going to always revert to 2%. And it's kind of, in a way, do you think, is it lazy? Is it kind of a lazy way to think of things that, oh, I'm just going to always project inflation to go down to this number. It's just how fast it gets there. And in a way, this is kind of like, okay, how much do we want to trust the analysts right now? Because look here, September of 2021, analysts are seeing that inflation is around 3 percentage points, let's say around there. And what do? They project, okay, well, it's going to go down. It's going to go down to 2%. So what do? Boom, boom, down to around 2% by September of 2022. Well, what happens? It's up here, right? It's not even close. They're not even close. It's totally off. So then, do we even really need to listen to the analysts? And are they going to get this wrong this time? Because so far they've been getting it wrong. And if they do get it wrong, the question is that going to be really, really bad for stocks? Probably it will be, of course, if inflation continues to go higher. But the good news here is that we could see a definite downtrend. We're looking right now, this is the 2022 time period right here. Look at the downtrend, and it's been a pretty quick, rapid decline in the downtrend of inflation. That's great. That's exactly what you want to see. That's something that's going to potentially help us out and make sentiment for the market better. But if we do see that there is a jump up some point in time, whether it's next month, the month after, the month after that, that could be very bad for sentiment because people might think, well, inflation might be coming back into the market. Then there's also the issue of the federal funds rate. One of the most important tools that the Fed has to fight inflation is the interest rate that they set, the federal funds rate. As you can see, the giant quick sloping uptrend line here up to 3.78 right now. And we're going to say, okay, well, what happens if they need to continue to increase interest rates? Because of course we're getting a decline in inflation, which we can see over here. Declining inflation good, which means that you might not need to end up continuing to raise rates too much. Right now, it seems like the market thinks that the Fed is going to take their foot a bit off the pedal. They're not going to raise interest rates quite as quickly and as much as they thought they were going to before. The market believes right now that there's a 74.9% chance that the Fed is going to increase interest rates to 4.25% to 4.5%. That's what they think the federal funds rate is going to be in December. Because the probability is so high of this happening, the market definitely thinks it's going to happen. So as long as it does happen, I don't think there's going to be too much change in the direction of the market. Of course, we do have that quadruple witching coming up. And so let's talk about how that has affected the market going back. This is just a simple day chart of the S&P 500. Let's go in and let's say, okay, let's look at the volume. We want to look at the volume on the top pane here. We have volume, and under it here, we have the S&P 500 and its downtrend right now. Look at the spikes in volume. I'm going to open this up better so you can see it better. I'm going to zoom in a little bit so you can see it better too. So let's take a look just at the year. We've got a year to date. So these are all volume bars, right? So how much volume was in the market on a specific day? That's what we're looking at here. Take a guess, random guess, just do it. What do you think, which days do you think a triple or quadruple witching day was? Do you think it's this one? Well, guess what? Friday, September 16th. That was a triple witching date. How about here? Oh, guess what? Another triple or quadruple witching date. How about here? Friday, March 18th. Guess what? Another triple witching date. We're talking about here is very seriously 100% something that does happen every single quarter. There is giant volatility in the markets at this point in time. What happened to the market during these witching events? Did it go up? Did it go down? Did it change sentiment? Did it change the trend? Let's take a look. I got some arrows here where some of those witching dates were. Here you can see Friday, the 18th of March in 2022. This was one of those witching dates. Big volume here. What happened? Well, of course, there was a decent bar, right? So there was decent price movement in the day. It wasn't quite as much even as like some other days, like for example, February 24th here. But what happens, you could see, is there was a continuation of the trend upward. So it didn't necessarily change sentiment at all. And in fact, it doesn't look like much difference happened. It just continued in its uptrend at that point in time. This next one on Friday, the 17th of June, 2022, this one's actually a bit different. You could see actually this is a low point where it looks like it really did reverse, or maybe sentiment shifted at this point in time during that witching date. Sentiment went back up and we had a bit of an uptrend, or at least a relief rally, let's say, at that point in time before we did hit some resistance. Not too far down the road, but you know, it did stop, let's say, some of the decline at that point in time. Friday, September 16th of 2022, we had another one here. Again, you can see the volume on the top here. You can see what happened. Actually, it looks like a hammer candlestick. So it hits that low point during the day, bounces back up, rallies back up. Next day, you get a green candlestick. So that's good. And then you do have the decline. So this may have actually been, at least let's say, a pause in the downtrend downtrend, or maybe the market really did try to reverse its course, but market participants weren't buying it and it kept going down. At the end of the day, it doesn't mean it's bullish or bearish. It just means volatility, and whether or not we get good sentiment, maybe because of inflation right now, maybe Fed funds that come out tomorrow, maybe that's actually going to help us get really a good potential triple, quadruple witching or whatever date, and it will end up helping the market get above this downtrend line that has been battling, where it hit 1, 2, 3, 4, 5 times. Okay, so it's trying to get above this downtrend and it's just not able to do it. If we zoom in here, we could see how close we are, and it looked like it was going to maybe get above that downtrend line back on December 1st, and it just didn't do it. Rejected, complete rejection off the line, comes back up, tries it again. It gets above it intraday and it closes below. Can it get above this line? Let's see what happens with Fed. Let's see what happens on Friday with the quadruple witching, and let's see if we can get a nice giant rally in the stock market, a Santa Claus rally, to get us back into this red box, which would be a positive year for the S&P 500. I don't think it's going to happen, but imagine if it did. We would have to basically rally from where we are today and up into 17%. Obviously, I don't think that's going to happen, and this little black line here is the end of the year, so it would have to rally 17% in, like, 13 days, and it's a shortened trading week because of Christmas and stuff like that. It's probably not going to happen, obviously, but maybe we can get up into a better, zone where the S&P 500 won't have looked so bad when we look back at this time period in the future. Hope you liked this video. Hit that like button, subscribe. Disclaimer here, and I'll see you in the next one.